What I would like to talk about during the next 30, 40 minutes is give a little bit my view of the Islamic banking field. I will present, I would say, 1.5 papers, but I kind of want to go a little bit beyond just presenting these 2 papers, because the first paper is already published, the second paper is very preliminary, and I just want to put this into a little bit of a broader perspective. Now I have to say first of all that I do not consider myself actually an Islamic banking expert. I've worked across many fields in banking and finance, both in developing, more recently also in developed countries. But if you do work in, as a banking finance person in developing countries, then it's very hard not to encounter the issue of Islamic finance. And for me, I guess on a personal level, it was mostly in across Africa, where Islamic finance is really part of the overall growth of financial systems across the continent. And it's actually not, as you might think, in Egypt, for example, or in North Africa, where actually Islamic finance, Islamic banking is relatively underdeveloped for many reasons that some of you might know better than me, but I think it has to do with political reasons. But it's actually across more sub-Saharan Africa that there is a push for more Islamic finance, where this is partly supply-driven, I have to say, by funds coming from the Middle East, for example, that would like to participate in the overall growth of finance in Africa, but also demand-driven, because there is a large Muslim population in sub-Saharan Africa, which of course varies across countries. But we also know that Africa is characterized by a high degree of financial exclusion. So making Islamic finance part of the trend towards more financial inclusion is of course a very important phenomenon, but it also imposes high challenges for regulators. Now, I'm not quite sure whether actually I need this kind of slide here as motivation. The Dean already alluded to it, that this Islamic banking is a very fast-growing segment in the financial system overall, across the world, including here in the UK, for example, where the financial center in London would like also to be a financial center for Islamic finance, for example, with attempts to issue sukuks in London. But for example, the country where I used to live until very recently, the Netherlands, is also would also kind of focus more on Islamic finance and participate in the global trend towards more Islamic banking. It's not just the more traditional countries where we can see this trend. Malaysia is, of course, I guess, one of the most developed financial systems with a large share of Islamic banks, the Gulf countries, Middle East in general, but again, also other parts of the developing world, such as I mentioned earlier, Africa, but of course also here in Western Europe, where Islamic banking, Islamic finance in general, is taking on a larger role. Then, of course, is the whole issue of stability and of Islamic banking being more robust during the global financial crisis than more conventional segments of the financial system. And I'm actually going to present some evidence to this effect later on. So just to remind us, and of course, again, I don't really have to say this in this context or with this audience here, the 5 main criteria for Islamic banking, which then turn basically into also certain challenges for banks themselves, for regulators. The prohibition on fixed interest rates, the prohibition on speculation, no financing of certain negative sectors, and instead of that, instead of the interest rates and instead of speculation, a focus on financial transactions that are directly linked to real transactions. That's why also leasing, for example, is so important. So no money for money, so no financial transactions that just are based on other financial transactions. And then finally, and I guess that's the really a positive element, is this profit loss sharing. That is not just a typical debt contract as we know it from conventional banking, but rather that the investor, the bank, ultimately the depositor, participates in the profit, possibly loss of the investment. So this is more from just the definition of Islamic banking. Now, if you look at the academic literature, it's actually fairly young. It's, I mean, there have been always some papers on Islamic banking, but it has really gained more prominence over the last 5-6 years, I would say. And I'm not going to try to make a complete literature survey here. I mean, there are lots of excellent papers looking at the bank efficiency, for example, which I don't list here, looking at specific countries. So I list only a few papers here. But there, of course, there are also many exciting papers here in the program, as far as I could see, that will also contribute to this literature. What I'm trying to say is it's a young literature and it's a very much growing literature, which I think can contribute quite a lot to the overall banking and finance literature as we know it. Now, as I kind of mentioned at the beginning, this is very much an issue beyond academia. It's very much a question on the mind of regulators and how to treat Sharia-compliant finance, for example, in the payment system, in the bond markets, in the interbank market. And again, this is an issue, for example, that we have discussed with regulators in Kenya, for example, in South Africa, and which often also triggers different reactions, where some regulators try to just fit it into the existing regulatory framework and just work with exceptions, for example, whereas others try to create a separate regulatory framework that deals specifically and explicitly with Sharia-compliant finance. It is also an issue for policymakers. Can Islamic finance be a component of the broader trend towards financial deepening and financial inclusion, especially in developing countries? And ultimately, it's also a question for bankers themselves. On the one hand, there are Islamic banks, there are Islamic bankers, but there are also many conventional banks that would try to go into Islamic finance to participate in the trend through, for example, Islamic windows, which does, of course, pose certain challenges because, as you know, as asset and liabilities have to be matched. So the Sharia compliance have to be on both sides of the balance sheet, not just on one of the two sides. So what I'm going to talk about, I'm going to present in a somewhat older paper, although it's just recently published, on where we kind of look very broadly, could call it almost like a bird's view on Islamic versus conventional banking across a variety of dimensions: efficiency, stability, business models. And then I'm going to present some more recent work on who actually banks with Islamic banks as opposed to conventional banks. Now, I have to say this title of the second paper, I basically came up with it last night on the train, so the paper doesn't actually exist. There are results, but there's no paper yet. Okay. So this is basically a paper that I started actually shortly after I left the World Bank, and it's kind of motivated by this observation that that on the one hand, Islamic banks have gained more and more importance, and also are based on the claim that Islamic banks might have been more stable, more resilient during the recent crisis. And what we basically do is we test different hypotheses, comparing a sample of conventional and Islamic banks within the same country. But let me talk this about in just a moment. Now, again, I'm kind of list these 5 characteristics. Now, one thing that I should also mention is that if you look across countries in terms that have Islamic financial systems, you also see a wide variety in sophistication, in complexity of these products. Again, on the one extreme, maybe you have a country like Malaysia with both conventional Islamic banks and very sophisticated products. On the other hand, you have countries, let's say, like Sudan, which have very new, very young financial systems, very rudimentary, also Islamic, but maybe the distance between a conventional bank and an Islamic bank in Malaysia is smaller than that between the Islamic bank in Malaysia and in Sudan. It's just a conjecture from my side. I cannot really prove it, but it's just what anecdotal evidence suggests. And of course, there's the issue of different interpretation of rules. So what might be Sharia compliant in one country and for one bank might not be Sharia compliant for another bank. So there are also different interpretation of the rules as far as I understand. Obviously, there are also different products. I list some here. Again, not going to go through them. But it's, of course, one of the challenges that we face when we study Islamic banking is that it's very hard from data, from broad data sources such as BankScope to actually look beyond the balance sheet into these details, which I think are very important and which I think should be part of the next step in the research agenda to go beyond Islamic banks and look more on the Islamic products that exist. Now, if we think about this kind of, before I show you some results, about what theory would tell us about the efficiency, stability of Islamic banks versus conventional banks, you could think about opposing hypotheses. On the one hand, the profit-loss sharing mechanism behind Islamic banking might make Islamic banks more stable because you have a direct link between the depositors or investors on the one hand and the borrowers or the entrepreneurs on the other hand, where the Islamic bank to a certain extent is more like a conduit rather than an intermediary because it passes on the risk to the depositor. So you could argue that actually there's more market discipline in the Islamic banking system than the conventional banking system. On the other hand, if you look at financial intermediation theory, banks do have an important role between these two groups of depositors and borrowers, and kind of taking away this intermediation between debt on the one hand, or fixed deposits on the one hand, and loans on the other hand, might actually reduce the incentive of the banks to properly screen and monitor borrowers, which would have the opposite effect of making Islamic banks more fragile. You could think similarly on the efficiency. You could think about Islamic banks being more efficient, more cost efficient, incurring lower costs because of lower screening and monitoring costs, because there is a direct link between the investors, depositors, and borrowers. On the other hand, given that Islamic banking is still a very young industry, there might be higher setup costs, and of course there is a compliance cost, which again also might make Islamic banking less cost efficient. Similarly, if you, and I don't have this in the slide, but if you think about business models and how we capture business models in variables, again it depends on how you interpret different parts, that you could observe different the variables going different ways between conventional and Islamic banking. So what we do in this paper is we focus on a relatively small sample of 22 countries where we have both types of banks. So we leave out countries that have only conventional banks, and we leave out countries with only Islamic banks. So Iran, for example, is not part of the sample. Why? Because we want to look within country and year. We want to really look at Egypt in 98 and compare within this country the conventional and Islamic banks, given that there are many other things going on across countries, different regulatory frameworks, different legal frameworks, different levels of economic development, financial development, cultural characteristics, and so on. We take banks that have at least 2 observations, and we only look at banks with at least 4, countries with at least 4 banks. And so we have to sample over 15 years. We have a big caveat, and again, this is more, I see this more as a challenge rather than a problem, that we use BankScope, which tries to make bank data consistent across countries, but there might be some of the richness of the differences between conventional and Islamic banking might, of course, get lost when we use BankScope data. Okay, this is just to show our sample. How many banks we have in each of these countries. As you can see, in the UK is in this sample. So we look at different variables. And again, it's a very broad exercise, a very kind of holistic exercise. We kind of divide them in 4 different categories. Business orientation, very broad sense, looking at what is the fee income relative to total income, which you might think is higher for Islamic banks. The funding model, wholesale versus retail, loan deposit ratio, where of course loans and deposits might be defined differently across conventional Islamic banks, but Bankscope tries to make it consistent. Cost income ratio, overhead costs, so are Islamic banks, conventional banks more cost effective? Asset quality, again, under the assumption that loans are kind of, the variable loans is made consistent between conventional and Islamic banks. And then finally, more stability measures for the overall banks, not just for the assets. Maturity match, liquid assets relative to the short-term funding, our standard measure of bank fragility or bank stability, Z-score, the return on assets, and the capital asset ratio, the capitalization of banks. And so the regression that we run, just to show you that, so we have one of these characteristics on the left-hand side. We control, in some regressions, we control for a couple of other bank characteristics, such as the size, the fixed asset ratio, non-interest funding. We look at, as I mentioned earlier, within countries and years. So we really compare, for example, Islamic and conventional banks within Egypt in the year 99, in the year 2000, and so on. And then the interesting, the variable of interest, the coefficient of interest is the one on the Islamic bank dummy. So compare Islamic to conventional banks. We cluster the standard errors on the bank level. And as you can see, for example, just give you a flavor, so the loan deposit ratio, so the how much of the deposits are being used for lending is higher for Islamic banks. However, Islamic banks are less cost effective, so they have higher cost income ratios, higher overhead costs, but they have better asset quality, lower non-performing loans, and they are better capitalized. So you can see these already kind of go in different ways. Less cost effective, but more stable. If you look at across different size groups, so here I am kind of arguing that small banks, the same as in conventional banks, small banks might be different than mid-size, might be different than large banks. That could also hold for Islamic banks. So for an Islamic bank, that's kind of a market leader that has been around for a long time, as opposed to a new bank, a startup bank that just started its business. And what we can see is, so here we compare these 3 groups of Islamic banks to conventional banks. And as you can see, many of these differences that we found earlier actually hold only for the small banks. Higher loan deposit ratio. We don't find for the small banks the cost effectiveness, but higher asset quality, so lower non-performing loans, and higher equity asset ratio. We also find that there are big differences. These are the p-values where we compare the large and the small banks, the small Islamic banks. So within the group of Islamic banks, there are also differences between banks of different sizes. Maybe not surprising, because it's the same we found around conventional banks. So it already tells us that Islamic bank is not equal to Islamic bank. Maybe most importantly, when we take our sample and instead of forcing the same coefficient on all Islamic banks across the sample, we say, well, let's look at kind of country by country and see that let's only compare, for example, Islamic versus conventional bank within Bahrain, within Bangladesh, within Egypt, and so on, and see whether they're different. The puzzling result is that there are enormous differences across countries. So for example, just to take this one variable, cost-income ratio. So in Bahrain, Islamic banks are less cost-effective. They have higher cost-income ratios. If you go down to Indonesia, you find the same result. If you go down to Pakistan, you find the opposite result. There the Islamic banks are more cost-effective, have lower cost-income ratios. And this is just a couple of countries, and we have more, the actual table is longer. Similarly, if you look at overhead cost, Bahrain, the overhead costs of Islamic banks are larger than conventional banks. In Bangladesh, it's the other way around. So what we see is really there's a lot of variation that we can't, it's very hard to make these statements across different countries. Similarly, equity asset ratio, yes, in most countries, Islamic banks are better capitalized than conventional banks, but there are also exceptions. Malaysia, for example, Egypt. Well, one of the reasons might be that we're mixing countries where the Islamic banking system is very small compared to the overall banking system, UK, also Egypt, with countries where the share of Islamic banks is very high. That's some of the Gulf countries. So maybe it has to do with that. And so that's not really, well, that didn't come out nice, but okay. So that's what we then do here. We kind of look at again, one Islamic bank dummy, but then also interacted with how big is the share of Islamic banks within the overall banking system. And as you can see, there are some important differences. For example, if you look at column 6 with the loan loss reserves, Islamic banks don't necessarily have lower loan losses per se, but they have so in countries with a higher share of Islamic banks. Or similarly with the non-performing loans. Islamic banks, if you look at the last column, Islamic banks in general are better capitalized than conventional banks, but this effect is less strong once in countries with a higher share of Islamic banks. So there are quite some differences, and if I split the sample, instead of looking at this continuous variation, I just split the sample into countries with high share of Islamic banks, with low share of Islamic banks, and compare the coefficient estimates, you can see that across some of these dimensions there are indeed differences. So some of these country differences that I showed you earlier might actually be driven by the different shares of Islamic banks. Now, the last thing we look at in this paper is that we look at the performance during the crisis. So now I just take my the same sample as before and see, just look at the loan quality and the stability indicators and see how this has performed specifically over the crisis. So in addition to my Islamic bank dummy, I also put in the interaction with the local banking crisis, because some of the countries, Malaysia, Indonesia, for example, suffered during the East Asian crisis, and then the global crisis, 2007, 2008. Just to make sure that this is not driven by some other trend, I also include the interaction with a global trend. And as you can see, Islamic banks are better capitalized, and again, you can see this as a result. This is kind of consistent across all the tables that I'm showing you, and it's even stronger during banking crisis. So the difference between conventional and Islamic banks in terms of capitalization becomes even stronger during crisis in the respective country. Similarly, it seems that Islamic banks are better in maintaining lending during crisis. If you look at column 4, let me see if I can. Yes, it does. Here, if you look at this, these coefficients here, you can see Islamic bank dummy in general is positive, but this effect becomes even stronger during local financial crisis. But they do not suffer more. So if you look at non-performing loans, they actually it's even lower during the crisis. There are some differences during the global crisis, although not as pronounced, but again, the non-performing loan ratio for Islamic banks during the global crisis was even even smaller than that for conventional banks. The final thing we do is we look at stock returns, and that's much shorter sample. I think it only goes 2005, 2009. Where we look at the stock return on the quarterly basis for a sample of Islamic and conventional banks. So it's a somewhat smaller sample, and we first include the variables as before, the Islamic bank dummy, and then the crisis dummy and the recovery dummy. And then we include all of these other variables, some of them as before, just to see whether we can kind of explain away any difference between Islamic and conventional banks. As you can see, again, in general, Islamic banks stock return less well than conventional banks, but this turns around during the crisis, so that actually during the crisis, Islamic banks perform better. And this holds, especially the second part, holds once we control for all of these other things that might explain stock performance over the crisis, including maturity match, loan deposit ratio, provisions, capital, and so on. And if we control for differences in some of these variables, for example, in the capitalization, between the difference between during the crisis, the Islamic bank dummy and the interaction with the crisis actually goes away, which seems to indicate that the reason why Islamic banks perform better during the crisis in terms of stock return performance has to do with the fact that they are better capitalized, but they also rely less on non-deposit funding, for example, and they have lower provisions. So there are certain elements in Islamic banks' balance sheets that can explain why they perform better than conventional banks, which of course is more interesting than to just say, well, they did better. So we can point to some reasons why they actually perform better than others. Okay, so this is just kind of a summary of our results. There are big differences. There are differences between Islamic and conventional banks, but at least as big as the difference between these bank types is a difference across countries in terms of Islamic versus conventional banks. They did perform better during the crisis, and it has partly to do with their higher stability, their higher capitalization during the crisis. Let me talk very briefly about a second paper. Again, this paper doesn't exist yet. It's some very initial work. What we do here is we try to find out what drives borrowers, or what explains why borrowers bank with certain banks, with conventional versus Islamic banks. What is the reason behind that? And this is there's some evidence that distance is very important for banking. So the Reise and Ongenaar, Hans and Steven have a paper on that using a data set from a large Belgian bank. And they basically show that the farther away as a borrower you are from your bank, the higher the financing cost. So there is an incentive to go to the bank closest by to minimize the information asymmetry between borrower and bank, and therefore also the financing cost for the borrower. The question is, if as a borrower, should you really go to the bank that is closest, or are you also partly informed by your religious beliefs and choose rather to go to an Islamic bank, even if it's farther away? So do you incur additional voluntary transaction costs for your beliefs in terms of going to an Islamic bank? We use data from Turkey for this, so a data set, a firm-level data set from Turkey, where we know the geographic location of the firm, and we know the geographic location of the branches, so we can match firm location with branch location, and we know which are the banks that the individual firm bank with. So this is this is our sample of around 7,600 firms. And as you can see, the large majority, the Turkish banking system has both Islamic and non-Islamic banks. But of course, there are other dimensions within the Turkish banking system that we have to look at, such as domestic versus foreign bank, but also state-owned versus private bank. And of course, again, they're large and small banks. So there are kind of different dimensions that we have to control for, so that we don't confound the difference between Islamic and conventional banks with some of the other dimensions. So as you can see, the large majority of our firms in our sample actually bank with conventional banks. There's a small group that only goes to Islamic banks, and some of them actually go to both. And as you can see, there are also variations, important variations across of these other dimensions that I just mentioned. Now, how do we actually look at this? And there are different ways to look at it. One is looking at the bank branch that the firm deals with, that the firm banks with, that is closest to the firm itself. Now, the reason why we have 11 instead of 7,000 is that some of these bank branches are basically in the same building. Some of the banks show up twice. So one of the firms have two banks that are closest to the firm because they are equidistant. And as you can see, on average, they are only 600 meters away. Now, if you look at all the branches that all the banks that an individual firm banks with, you can see it goes up a little bit. So now we have, on average, two banks per firm. And the average distance to the bank branch that you bank with is 1.7 kilometers. Now, if you look at across all the 30 or so banks in Turkey and just take the closest branch of each bank and then link it to the firm, you can see that actually the distance, of course, goes up quite a lot. Now, this is the sample for all banks. And then if you look at compare Islamic and conventional banks, the interesting thing is you can't see actually much difference in terms of the bank they bank with. Now, what do we do next? We next look at compare the distance to the individual bank branch for each firm. So for each firm, we look at the banks that the firm banks with and measure the distance and then distinguish between different bank types. Islamic banks, large, small, foreign, domestic, state-owned, private, and see whether the distance increases or decreases in these different bank types. This is measured in logs, so it's kind of a percentage difference. As you can see, is that in general, Islamic banks, so if a firm banks with two different banks, a conventional and Islamic bank, the Islamic bank tends to be further away than the conventional bank. So it's kind of like firms are willing to go the extra meters or kilometer to go to the Islamic banks. Although it is mostly for the large bank, for a large Islamic bank, they are willing to do that, not necessarily for small Islamic banks. So if you look at the interaction term here. So this is one way to look at this. This is just the distance from the firm's viewpoint relative to the nearest bank branch. We can also just kind of turn the question around and say, well, if I look at the universe of bank branches, so I take my 30 banks in Turkey, and just for each firm, I locate the closest branch of each of the 30 banks, and then ask the question, as a firm, are you connected to the closest branch or not? So kind of doing a probability model. Again, so in this case, I kind of turn the question around. Are you connected or not as a firm as a function of distance, and it's a function of different types of banks and then interacted with the distance. So the first result is not surprising. The farther away a bank branch is of the 30 banks in Turkey, the less likely you as a firm are connected to it. So very obvious, you choose the banks that are closest to you, or one of the banks that is closest to you. However, that is kind of overturned if you look at Islamic banks. So for Islamic banks, it seems to matter less how far away the bank is, which is consistent with the previous result. So you're kind of going the extra mile to follow your belief. However, that result kind of goes a little bit, turns insignificant once we control for the other interactions here, the other characteristics of banks, including whether it's size, foreign or domestic, or state versus private ownership. So as I mentioned, this is kind of very initial results, but it gives you some indication already that there is Islamic finance can be attractive for borrowers, for firms, and they might be willing to go the extra mile to bank with a financial institution that's closer to their own beliefs. So let me then maybe close with some final remarks, and maybe then also open up to our discussion. Where do I see this going next? And I hope I can provoke discussion because I just don't think it's just my personal view. I mean, there are a couple of questions I find very interesting, and I know there are many other interesting questions that are going to be discussed in this conference. So, for example, maybe you can observe the expansion of Islamic finance. What drives it? Is it more demand for Islamic products, or is it partly also financial resources looking for a home? So looking for conduits, for vehicles to be lent. So the pull versus push factor. What is the extent to which Islamic finance, Sharia compliant finance, can contribute to financial deepening and financial inclusion? Is of course a question that's very much on the mind of policymakers, for example, in sub-Saharan Africa. Who uses Islamic banking? Again, I'm trying to answer a little bit with that in my previous slides, but that's a question I think we have to explore much more, especially for countries where you do have both types of financial institutions. Of course, in order to answer all of these questions, I think we need much more data. We have a lot of aggregate data, and the first paper I presented uses some of these aggregate data, but I think we really have to go below that. We have to go much more beyond the bank level, on the product level, and better understand different products, how they're being used by banks, why they're being used by the banks, looking within the banks on the governance structure, for example, the regulatory framework, to drill much deeper there. Similarly, we talk about Islamic versus conventional banks, but of course there's one important trend, and that is many conventional banks now also opening Islamic windows. So trying to look again deeper there is important, which of course balance sheet data won't be enough, because Islamic windows are within the balance sheet, so trying to isolate them and look at that, that's very important. And ultimately, I think we really have to go down to firm household or loan level data, such as done by the other paper that Barle and Andrena and their PhD student, which looks at the credit registry data from Pakistan, for example. So much more detailed data, loan level, but also firm and household level, I think will help us answer many more questions. Final slide, I've been talking about Islamic banking, but of course there's much more to Islamic finance than banking. There's a whole issue of microfinance, insurance, bond markets, and so on. So I think I only covered a very small part, and I think there are many more parts to this overall agenda. Thank you very much.